There is no such thing as one silver price anymore. That's the first thing to understand. On paper, silver is still trading in the low 70s. Calm, controlled, normal. But at the same moment, in physical markets across Asia, the same metal is changing hands at over $100 an ounce. In some places, far more. Two prices, one metal, no bridge between them. That contradiction matters to you because global markets are built on the idea that price is universal. One truth, one signal. When that breaks, everything built on it starts lying by default. This isn't a temporary glitch. It's not a data delay. It's not regional noise. The mechanism that used to force prices back into alignment has stopped working. And when arbitrage disappears, control disappears with it. Here's the uncomfortable part. Most people are still looking at the cheaper number, assuming it's real. But markets don't collapse when prices spike. They collapse when prices disagree. And once you see why silver now has two realities at the same time, the rest of the system starts to look very different. To understand how this happened, you have to stop thinking in terms of glitches and start thinking in terms of pattern. The silver market didn't drift into this split, it snapped. For decades, the idea of a single global spot price held everything together. Paper contracts in the West and physical metal in the East stayed loosely aligned because arbitrage enforced discipline. If prices diverged, traders stepped in, metal moved, and the gap closed. That's no longer happening. In early January, the paper price kept updating as usual, calm and orderly. At the same time, physical markets began trading at levels that made no sense under the old rules. Triple digits, no discount for waiting, no incentive to sell. The two sides stopped talking to each other. But here's the framing shift most people miss. This isn't a pricing error. It's a signal that the mechanism itself has failed. When the bridge between paper and physical breaks, the price you see depends entirely on where you stand and whether you can actually get metal. Notice the question nobody wants to ask yet. If the cheaper price can't buy real silver, what exactly is it pricing? And once that question is on the table, the story stops being about markets and starts being about control. Here's the proof point that turns suspicion into confirmation. This split didn't emerge quietly. It was forced. At the end of last year, Western buyers made an aggressive move to secure massive amounts of physical silver directly. Not through normal channels, not through exchanges. They tried to bypass the system altogether and go straight to the source. And they were turned away. Shipments meant for Western delivery were rejected at the port. Offers weren't negotiated, they were refused. Even when payment terms were stretched, even when traditional settlement methods were abandoned, the answer didn't change. No metal. That detail matters because it tells you something crucial. This wasn't about price disagreement. It was about denial of access. When a seller refuses a buyer regardless of terms, the market has crossed from commerce into strategy. Notice what's missing from the response. There was no counteroffer, no higher bid accepted, no delay for logistics, just a hard stop. This is where the story flips. When physical supply can be withheld regardless of demand, the paper price loses its authority. It becomes a reference, not a reality. And once that happens, the question isn't whether prices will converge, it's which one survives. After that refusal, everything accelerated. The system tried to reassert control the only way it knows how, by squeezing paper. Margin requirements were raised sharply and repeatedly in rapid succession with the clear intention of forcing traders out and dragging prices back down. Capital requirements jumped overnight, leverage was punished, the message was simple: back off. And for a moment it looked like it worked. Prices dipped, headlines calmed, but the calm didn't last. Here's the escalation most people missed. Even after the most aggressive tightening in years, the price didn't collapse. It snapped back fast. That tells you the pressure wasn't coming from fragile speculation. It was coming from somewhere that doesn't care about margin rules. Historically, this kind of intervention worked because it scared paper holders into selling. This time there was nothing left to scare. The demand driving the move wasn't leveraged. It wasn't optional. It was physical. That's the normalization moment. When the strongest containment tool fails, the market quietly accepts a new reality. Control measures become signals of weakness, not strength. And once a market reaches that point, the next stress doesn't hit prices first. It hits balance sheets. Now the evidence turns systemic. As prices stayed elevated, pressure surfaced where it couldn't be hidden anymore. Inside the banking system, liquidity demands spiked. Emergency funding was tapped. Not gradually, but all at once, right as silver was making its most violent moves. That timing isn't coincidence, it's correlation. Here's the contradiction that matters. On paper, banks insist everything is orderly, but behind the scenes, replacement costs are exploding. Metal that was sold years ago at far lower prices now has to be sourced in a market where physical silver trades at massive premiums, if it trades at all. That gap doesn't show up as a headline loss, yet it shows up as stress. And notice what banks don't want to emphasize. Settlement behavior is changing. More counterparties are asking for delivery instead of cash. That forces sourcing. That forces exposure. And when inventory is thin, exposure becomes dangerous. This is the line that permanently reframes the story. Silver isn't stressing the system because it's large. It's stressing the system because it's small enough to be overlooked, yet critical enough to matter. When a minor market starts pulling emergency liquidity, it's not the market that's fragile. It's the structure around it. And once that realization spreads, pressure doesn't dissipate. It compounds. From there, the pressure spilled straight into the real world. Retail didn't ease into this, it snapped. Dealers watched inventory evaporate almost as fast as it arrived. What used to sit in cases for weeks was gone in moments. Showcases emptied. Phones rang non-stop. Backstock disappeared. In some places, stores stopped answering altogether because there was nothing left to sell. This wasn't calm accumulation. It was recognition. People weren't shopping for premiums or comparing products. They were buying anything that contained silver, bars, scrap. The distinction between collectible and generic vanished. Availability became the only filter. Notice how fast psychology shifted. High prices didn't slow demand, they accelerated it. Because when people realize access is closing, price stops being a deterrent and starts being a warning. This is where control really starts to slip. When retail demand disconnects from wholesale supply, the distribution chain breaks. Dealers can't restock, mints can't keep up, delivery timelines stretch into uncertainty, and that creates a dangerous loop. Scarcity fuels urgency. Urgency fuels buying. Buying deepens scarcity. So pause here and ask the uncomfortable question. What happens when even the last layer of inventory is gone? This is where it stops being abstract and starts landing on people's lives. When physical silver disappears, the response isn't orderly. It's improvisational. Local rules change. Taxes appear overnight. Transactions that were routine suddenly carry penalties. In some places, buying or selling metal no longer feels like commerce. It feels like evasion. That shift matters because it reframes behavior. People aren't reacting to price charts. They're reacting to pressure. When preserving value starts attracting friction, citizens adapt quietly. They drive farther. They trade differently. They stop using familiar channels. Here's the part most coverage avoids. These policies don't slow demand. They redirect it. Legitimate businesses suffer first. Small dealers close, informal markets grow, transparency collapses, and the system loses visibility over what people are actually doing to protect themselves. If you've ever watched rules tighten right when something becomes scarce, this will feel familiar, because it's not about silver, it's about what happens when institutions treat self-protection as a problem instead of a signal. If this feels familiar, say so in the comments. Because once everyday behavior starts shifting underground, the system has already lost something it doesn't get back easily. Step back now, because this is where the mechanism fully reveals itself. Silver isn't exploding because everyone suddenly wants it. It's exploding because alternatives are disappearing. When gold becomes unavailable, unaffordable, or delayed, pressure doesn't vanish. It slides, it moves down the ladder, and silver is the next rung. That forced rotation changes the entire dynamic. Capital that would normally spread out gets trapped. People walk in intending to swap, rebalance, or upgrade, and find there's nothing to move into. So they stay where they are. Demand compresses instead of dispersing. At the same time, supply can't respond. Silver isn't mined on command. It's mostly a byproduct tied to other industries that aren't expanding fast enough to matter. That means higher prices don't bring relief, they bring competition. Industrial users and investors end up fighting over the same shrinking pool. This is the unsettling insight mainstream coverage misses. The system relies on elasticity that no longer exists. When supply is inelastic and demand is forced, volatility becomes structural. And once volatility becomes structural, stability isn't restored by policy or reassurance. It's restored only by exclusion. From here, the trajectory gets uncomfortable because there's no clean reset. One path forward is fragmentation. Prices continue to diverge by region. Availability becomes local. What you pay depends on where you are, who you know, and how fast you can move. The idea of a global reference price fades into background noise, replaced by lived reality on the ground. The other path is repricing. Not a spike, not a crash, but an adjustment where the paper market is forced to chase the physical one upward, simply to remain relevant. That doesn't require panic. It requires acknowledgement, an admission that the old anchor no longer works. What makes this moment dangerous is timing. This split is happening while trust in institutions is already thin, while capital is already restless, while alternatives are already under strain. That makes overshoot more likely than correction. And notice the momentum. None of the pressures driving this are resolving. Supply isn't expanding. Access isn't easing. Behavior isn't calming. Each day the system adapts to the split. It makes reunification harder. So the next move may not be dramatic. It may be quiet acceptance. And once acceptance sets in, the price you remember stops mattering. Here's the insight that closes the loop. This isn't a story about silver becoming expensive. It's a story about silver becoming honest. The moment the market split, it exposed which prices were backed by metal and which were backed by assumption. Once that line is visible, it never fully disappears. What collapsed wasn't confidence in a commodity. It was confidence in a mechanism. A system that depended on everyone believing one number could represent reality everywhere at all times. That belief is gone now. From here on, silver trades less like a product and more like a signal. A signal of where control still exists, where it's slipping, and who feels it first. And silver won't be the last place this shows up. If you want to understand which markets are next to fracture, which prices still mean something, and which ones are quietly drifting away from reality, follow and subscribe. This story doesn't end with silver, it starts with it.